This is Jody Trana for Chapter 2, Part 1 of Principles of Accounting. I want to give you an idea about the learning that you should experience in this class. You already know that in the accounting system we post transactions to accounts. You see some examples of accounts in the graphic here, such as cash, land, capital, withdrawals, prepaids, and payables. As you learn more about individual accounts, you need to immediately know these three things about each account. You need to know what account category that account is in, whether it comes from the assets, liabilities, equity, revenue, or expense account category. You also need to know what the account is generally used for, and finally, you need to know what the normal balance is of the account. You need to know whether the account usually has a debit balance or a credit balance. Let's look at cash as an example. Cash is in the asset category. The cash account is used to record all cash that comes into and out of the business. And the cash account has a normal debit balance. All assets have a normal debit balance. You'll need to know these three things about every account in business. Knowing the normal debit and credit balance of all the accounts isn't as hard as it may seem. It all stems from the accounting equation. Normal debit balances such as cash are on the left side of the accounts, just like assets are on the left side of the accounting equation. And normal credit balances, such as accounts payable, are on the right side of the accounts, just like liabilities are on the right side of the accounting equation. Equity is a little more complicated, but we'll talk about that later. Let's look at the spreadsheet that includes all accounts of a particular company. Notice that some accounts are listed on the left side, the debit side, and some accounts are listed on the right side, the credit side. Look closer and you'll see that all the assets are listed on the debit side. All the liabilities are listed on the credit side. The equity is listed on the credit side. The revenue is listed as a credit. And the expenses are all listed on the debit side. These are all considered to be normal balances. In order to adjust these balances to make them go up or down, we don't add and subtract in accounting. We debit and credit. You know how sometimes we feel that positives are good and negatives are bad? Well, debits and credits are not like that. Debits are not good and credits are bad. And debits don't always increase an account, and credits don't always decrease an account. How we record increases and decreases to an account is determined by the account type and the normal balance. For any given account, increases are recorded on one side and decreases are recorded on the opposite side. Assets are always increased with a debit and decreased with a credit. Liabilities are always increased with a credit because they have a normal credit balance. And equity also, these accounts are always increased with a credit because they have a normal credit balance. Whether an account is increased or decreased by a debit or a credit depends on the type of account and its normal balance. Take a minute to identify each one of these accounts for its account category and its normal balance. Think about where this account hits on the accounting equation to determine its normal balance. Those items that are on the left side of the accounting equation have a debit balance, and those items on the right side of the accounting equation have a credit balance. Pause the video until you're ready to see the answers. There was one tricky one on here. There's two assets, and both of the assets have a normal debit balance. And there are two liabilities on here. Both liabilities have a credit balance, just like the accounting equation. But we have one equity with a credit balance and one equity with a debit balance. Remember that equity is on the right side of the accounting equation, so it should have a credit balance, and the capital account does. But withdrawals reduce equity. When owners take money out of the business, that's a withdrawal. It reduces their rights to the assets. It reduces equity. That's why withdrawals have a normal balance opposite of the normal balance of the capital account. Capital increases equity, and withdrawals reduce equity. Let's take a closer look at the normal balances of the accounts in the equity section. We already learned that the normal balances of assets are debits, and the normal balances of liabilities are credits. When you combine all the accounts in the equity section together, they should have a normal balance of a credit. Let's look at each one. Owner capital has a normal balance of a credit, just like equity in the accounting equation. Owner withdrawals has a normal balance of a debit because it reduces equity, so we have the opposite balance to offset the capital account. Revenue has a normal balance of a credit because when we receive revenue, that's sales, it increases our equity. It increases the owner's rights to the value of the assets. And conversely, expenses have a normal balance of debits because when we spend money, it decreases our equity. Now pause the video and identify account categories and normal balances for these accounts. There's a couple of tricky ones here, so let's look at all of them. First of all, advertising expense. Revenue and expenses both are in the equity section. Since when we pay out expenses, we reduce our equity, this has a debit balance because remember, equity is on the right-hand side of our accounting equation and has a normal balance of credit. So expenses with a normal balance of debits will reduce our equity. Interest revenue and service revenue are both equity accounts, and they both increase equity, so they both are credit balances. Unearned revenue. This is revenue that we haven't actually earned yet. We've received some money, but we haven't done the services, so we have an obligation to provide the services or give back the money. Liabilities are a credit balance. Prepaid rent is an asset and is a debit balance. When we prepay anything before we don't actually owe it, that's an asset to us because we could get that money back if we needed to. This exhibit shows the chart of accounts for Smart Touch Learning. A chart of accounts is used to organize a company's accounts. It lists all the company accounts along with the account numbers. Account numbers are just like a shortcut version of the account names. One account number equals one account name, just like your Social Security number. In addition to the chart of accounts, companies need a way to show all of the increases and decreases in each account, along with their balances. Companies use a ledger to fulfill this task. A ledger is a record holding all of the accounts of a business, the changes in the accounts, and their balances. A ledger provides more detail than the chart of accounts. Here you can see in our cash ledger, there's a debit column and a credit column with the balance following. Notice that in this ledger we have a T account. We will use T accounts a lot in this class. A T account is a simple way to look at the debits and credits in a particular account. We could calculate the balance of this account by adding up all the debits and subtracting the credits from that number. The side with the largest balance gets the total. In this case, cash has a debit balance, and so we write the total $26,300 on the debit side. Here's how a T account works. Because cash is a normal debit balance, we increase the cash account by debiting. That's on the left side. If we want to decrease the cash account, we credit it on the right side. This only works for accounts that have a normal balance of a debit. Accounts with a normal balance of a credit would be done just the opposite. Put all together, the T account works like this. You would have all of your debits listed on one side and your credits on the other side. You would add together the debits and subtract the credits for a normal debit balance account and come up with the balance. Normally you'll find that the balance goes on the side that is appropriate for that account, the normal balance side. In this case, the cash balance is normally a debit balance, and we do have $12,300 left in this account. Accounts payable has a normal balance of credit. So in this case, we would add together all of the balances on the credit side, and we would subtract the numbers that are on the debit side. If you got a balance of $3,500 credit, you're right.